There's no way to sugarcoat it. Last week, the switch flipped to risk off as traders locked in gains and rotated either out of the market or into safe haven assets. Take Thursday. Futures Thursday gapped lower on seemingly no news. Risk assets were for sale across the board. Popular themes like AI, nuclear, high beta tech all struggled to stay afloat. And finally, sectors that have been dead all year finally got some love. We come in this morning and it's like nothing happened last week. So what was this? Was it a warning shot? A shot across the bow of regime change on the horizon? The unwind of the most popular trade in our lifetimes, AI, or just another reversion to the mean and buy the dip moment that has been one of the most popular trades this year? Let's get some answers from 25-year veteran John Davi, founder and chief investment officer of Astoria Advisors. Welcome to The Money Runner. I'm David Nelson. John Davi, welcome to the show. Thanks so much for being with us today.
Thank you for having me, David.
Hey, John, I was looking at, thank you for sending over your resume. It's off the charts, all right? You worked in a very prestigious role at a firm I used to work at years ago, Morgan Stanley, except I came in through the back door. You were there, obviously, at the top. You were head of Morgan Stanley's institutional ETF content and structured ETF portfolio solutions, pretty big title. And then you started Astoria in 2017. So you're the perfect guest to answer my first question. And I want to go to the chaos last week. I want to go right to the heart of it. Last week, factor performance was led by things like low volatility, value, dividends, quality. We come in today, we kind of reverse all that. Kind of spooky stuff. Where do you come out on that?
Well, we, obviously we had a government shutdown. It looks like that's ending. And, I think the way the market is set up, when we think about where we are in the cycle, when we look at like estimate revisions being revised higher, when we think about, the year-end seasonality, we are constructive. I think there's a couple of reasons. One is you have tax cuts, tariff cuts, the Fed is easing. So, the idea is like you don't fight the Fed. And, I think we're very much still in this bull market. So we're a little bit constructive, but natural retracements like we had last Thursday, you mentioned, shouldn't be, like an ominous warning sign. I mean, this is sort of natural progression for, what is a bull market that's been, lasting for several years now. So we're constructive, and I'm looking forward to having this chat with you.
Your former shop, Morgan Stanley, put out a note recently about volatility. And I'm looking at a VIX chart right here. Pretty low levels. We're in the lower quadrant, really, of where the VIX has been for the last couple of years. But they put out a note saying that individual stock volatility is at some of the highest levels in decades. In fact, they go on to say that stock moves in response to earnings this season, and I've lived through some of this, are at the highest levels since the financial crisis. You guys buy stocks. I look in your portfolios. You are stock managers. How have you managed to navigate that?
Well, so our quantitative stock selection models are actually having a really good year. One of the best years, since we began the firm. And I think there's a couple of reasons. One is that, stock-specific risk is high. Two, I think like the way we sort of mine for the alpha within a beta, using this like time-tested approach that I've been using for 25 years, is working. I think like, so if you look at like where we are in the earnings cycle, I mean, even though like the stock's reaction is low, the median stock it's having its best EPS growth in 4 years, and the S&P 500 revenue beat rate is 2 times its historical average. So, we're sort of in a good earnings season. You just got to like make sure you pick the right stocks. And of course, we tend to be very quantitative rules based, which I think is like better than just, picking stocks for, whatever your individual thesis is. So that, that makes sense. We're sort of late in the year. A lot of the 401k drip effect is over. beginning of the year tends to have like this drip effect where people buy more like index level products. And then, as the year goes on, that tends to drift a little bit. And there's just more idiosyncratic risk in the market between, the Fed, do they cut again? You have geopolitical risk. You've got, plethora of risks out there. You have the government shutdown risk. So we like to stick with our process, which is time tested. So
let's talk about earnings then. I think for this year, most consensus is somewhere around 12 to 13% this year, 12 to 13% next year. That's pretty healthy. That's the good news. The bad news is that stocks are going up faster than that. And that has to do something to multiple compression, or rather multiple expansion, which is what we're seeing. The market continues to get more expensive. Can we keep doing that? What's underpinning that? Can we expand the multiple and still, have this bull market thesis?
So my big call and what we're kind of striving for at Astoria is that, listen, the Mag 7 has that incredible, earnings growth. They are expecting like 23% of the Q3 net income versus 12% for the S&P 493. But over time, what you'll see is that Mag 7 goes down, the 493 kind of comes up, and they sort of converge, middle to late next year. So, our view is like tilt away from the Mag 7 because those stocks are expensive. I would say in aggregate, they're not like 1999 bubble valuations. They're just, exceptionally high, but, they do grow, and they do grow their net income and their revenues, quite substantially. It's just that over time, we do see like this conversion. So we do like to tilt away. I think you got to anchor your portfolio risk around Mag 7 stocks. You could use SPYs and Qs or some version of large cap tech or blend, but on the margin, we're all about tilting away towards, it could be eco weight, it could be international, it could be real assets. Those three, eco weight, international, real assets, those are three top tilts away from the the Mag 7.
You mentioned tech in the Mag 7, and I can't turn on a TV program where there's CNBC, Bloomberg, the financial press. It's just almost ad nauseum talk about the bubble. The comparisons back to the .com. I was there. Maybe I was earlier in my career and I didn't know as much, and I remember some of the caution signs. I remember. The Y2K issues, the double ordering, the dark fiber, that was a strong leading indicator that maybe we were overbuilding. But I'm not seeing it right now. I'm not seeing there's no dark GPUs out there. They don't seem to have enough of them. We do have some constraints. Power seems to be a pretty big deal. Where do you come out on it? You seem pretty constructive, at least on the market.
Yeah, we are. We are overweight to equities is the lowest it's been in 7-8 years, just because obviously we're in the later stages of the cycle, and the third year of the bull market typically is nonlinear, I would say. But when you look at the free cash flow for the median large cap stock, it's three times as it was in 2000. So the simplistic way I would say, David, is like, in the late 90s, these were like very high valuations, but there was not a lot of profitability. The Mag 7 is some of the best companies ever created. They have like true earnings, true profitability. They can scale. They can sort of grow in any environment. They're not nosebleed valuations in aggregate across the Mag 7. But I think it's like people just like to say bubble because it gets a lot of clicks. But, we're very much in this bull market. I think it's going to last. And there are effects of like the passive, the 401k drip, ETFs are going to take in, 1.1 trillion of inflows. A lot of that, it's in large cap tech stocks. So we're just in a very different environment. Back in 2000, it was like a lot of stock picking, mutual funds. Now it's more passive. It's more, it's less about specific stocks. So markets look and feel different, but I think there's no comparison. I don't think we're in a bubble. I think there's other things that concern me a lot more, like the debt cycle that we're in, the deficit risk, how bonds are reacting to this environment. I put out a note today that the ag index is up, 6.8% year to date, and people are like, oh, that's great. But half of that's been lost to inflation. So I really worry about after tax, after inflation, risk-adjusted returns.
If we're going to talk about bonds and rates, we got to talk about the Fed. They've been obviously the narrative kind of flipped in the last couple of months. The Fed is at least clearly for the moment on an easing path. It's debatable, how long that path may play out. I think Powell wanted to take away, at least get control of the narrative, because the market was pricing in all these cuts. And the last time I looked, let me see if I got the numbers here. But the last time I looked, I think it's maybe a 62% probability of a cut in December. That's down a lot, so it's clearly we're pushing it out. Does that really delay the thesis? It obviously delays the thesis, but does it upend it? Is it still the same story? Rates are coming down.
Well, I think it is. I think, obviously, so the Fed cut last year 100 basis points. That sent the 10-year higher. They didn't get the desired effect that they want. They cut twice already. This is a very controversial topic, right? Because their mandate is to get, full employment, 2% inflation. Inflation's at 3%. We're inflation hawks. We've been arguing for 5 years that we're going to be living in a structurally higher inflation world. But I don't think there's any tolerance in this administration to get inflation down to 2%, because the way you do that is to actually, hike rates and not to cut it. But, we're sort of cutting because the way this inflation cycle has gone on is that, it's really hurt the middle to lower class. And it's helped like the hyperscalers and the top, 1%, the top 10%, which dominates the economy. But, we are entering like the mid-cycle. And I think that, the Fed is sort of like understanding that, you really can't get inflation down to 3% without tanking the economy, which is just not going to help anyone. So I do think they cut in December. I think there's another cut next year. But, what I try and tell our investors, David, is like trying to forecast the Fed. It's better off you build a resilient portfolio, be systematic with your approach. Last comment I'll make about the Fed is that, like, no matter what, like Powell's out, Trump's going to put someone else in that he wants that's going to ultimately lower rates, because Trump is, a low interest rate guy. And I do think that helps the middle class, and it gets housing, it gets the mortgage rates down, which helps the housing market. Obviously, we have this like massive, housing issue in the States. So I would bet that there's going to be lower interest rates.
Let's pivot for a second, because you kind of alluded to it in a second. You've written a lot about the so-called debasement trade and real assets. And it'll help me pivot to one of your funds, which I find really interesting here. Let's just start off with the debasement trade. What's the call here?
The debasement trade is growing skepticism that fiat currencies are going to maintain their real value over time. I would tell you that the US dollar has lost 53% of its purchasing power over the last 30 years. This is just a natural thing, right? Like inflation erodes purchasing power. Like, again, so when I started the story, I said, look, there was going to be three things that we sort of is our true north, right? One is after tax returns. Second is after inflation returns. Third is risk adjusted returns, right? So after tax, after inflation, risk adjusted returns. So everything should come back to that. And the point is, like, we've always hedged our purchasing power risk by owning like commodities, owning natural. We've changed over the years. Like some years it was good to own commodities. Some years good to own gold. About 5 years ago, we said, like, look, let's own real assets, like more on the equity side, because these things were like 6-7p ratio. And we saw that like M2 velocity of money was skyrocketing. And we just had this call that inflation was going to skyrocket higher. So the debasement trade is, still tied into like all these themes, which is like, erosion of purchasing power. We are living in this world of like structurally higher inflation, higher interest rates, although I just said that, we think it's going to come down. We think that there's a lot of deficit risks. Governments all over the world are sort of like shifting to like large deficits, more fiscal intervention. Central banks have been slow to increase, to shrink their balance sheets. there's deglobalization, onshoring, energy transitions. There's all these themes, I think, that are kind of fighting. And what that is most currencies are being debased. And I think you kind of see it in the gold market. It's up 50% year to date. Gold is up like 70% the last 2 years. Bitcoin, for those that watch Bitcoin, I mean, this was, when we put out a report, 2018, Bitcoin's at 10,000, right? We're now at 100,000. So Bitcoin's a response to, the debasement trade. So we just say, look, hedge it's not about nominal assets, it's about real assets, and just hedging that weakening dollar, higher inflation risk.
You've put out an ETF to that regard, and I really want to dive into it. PPI, Papa India. I looked at this, and first, congratulations on the year. You're having a phenomenal year, but I looked inside the portfolio. This is not your typical exchange-traded fund. For most people, you look inside this thing, it's going to look very, very different in here. First, it seems like you had a passion as to it seems to fit in with your debasement thesis. What made you choose like an equity way to approach it as opposed to maybe owning the hard assets themselves?
Great question. So the fund is actively managed just because in something very nuanced, we think you have to be actively managed. Two, when we launched this, and we're coming up on a 4-year track record, in the ETF, the SMA goes back like 5+ years. I would say that these things were trading at like 6-7 P ratio, these, natural resource, industrial stocks, energy stocks. When we launched it in December 2021, Russia was invading Ukraine. So owning a lot of, gold and energy equities proved to be like resilient. So the first year we launched it in 2022, the fund was up like 4%. And the S&P was down 18% that year. So we had this inverse correlation because of the exposures we had. Over time, we've changed the exposures. Right now, gold, not that we trimmed a lot of gold. Gold just went up, quite a bit. But we've added Bitcoin. That was more of a recent add. The industrial stocks, the natural resource stocks, the infrastructure stocks, depending on where we are in the inflation cycle and valuations. But net, the fund has averaged 80% equity, about 10% commodities. And, we did own tips because they were pretty attractive, less so now. So we've had about 70% correlation to the S&P since we launched it. It's 4 stars by Morningstar. And believe it or not, David, but, since
congratulations. That's an awesome for in such a short amount of time, and it is a unique strategy. And well, let me ask you this: like, if you were advising a wealth manager, what percentage of their assets should an investment like this represent in a fully diversified portfolio, a typical balanced portfolio?
Yeah. So good question. I would say 3 to 5%, depending on how much risk. If you're running 60-40 versus 80-20 or a 20-80. Just remember, like in a 60-40, right? Your 40 is bonds, which are nominal bonds, right? So year to date, the ag is up almost, let's say 7%, but inflation has averaged per the CPI 3% right now. But like the retail investor, the person that actually is managing, the advisor that's managing the end client's money. Inflation is well north of 3%, right? You go to the grocery store, you get your car fixed. It's well north of like 6%. So on a nominal basis, you've lost out to inflation. So we just say, look, if you put 35% of your portfolio in something like PPI, you'll help navigate this inflation risk.
All right, let's maybe pivot here because I've been reading your stuff all week, and you've talked a lot about international stocks. And I want to start off by saying, look, every year I got the memo. Every year for the last decade, I got a memo about you have to invest in emerging markets. This is the year the valuation spread to the United States is so much you can't ignore it. Yeah. And every single year it didn't work. This year it's been a home run. Why?
Well, it's all based on a dollar. When the dollar weakens, that generally helps international markets. So like full stop, that's the easy kind of explanation. I would say we started the year, I'm just going to focus on a dollar euro because that's the easiest one for, to kind of convey. But, we started the year at 103. And if you think about like us issuing debt, more deficit, I mean, who's going to, we have a ton of supply, who's going to buy the bonds? So it's sort of easy to understand that this debasement trade, you've got everyone that's kind of weakening the currency to sort of compete. The long-winded answer, I would say, David, is that from 2010, after the great financial crisis, to 2020, we were living in a zero interest rate world. We were mired in deflation. It was all about tech stocks, tech dominance, right? What happened in 2020? COVID, right? After COVID in 2020, we were living in a higher interest rate world, higher inflation. It did take now the dollar years to react, to weaken, but there's no surprise that once the dollar weakened, non-U.S. markets, did well, which is based kind of in history. I mean, typically, like since 1990, this analysis we did, whenever the dollar falls 10% or more, which it did this year, EM goes up on average 28%, developed market goes up 15%, on average since 1990 when a dollar weakens by 10%. And sure enough, this year EM is up 30, DM is up like 25, 26%. So we're just following the cycle of what happens when the dollar weakens. But it is no surprise that it kind of happened amidst, all this deficit risk, the debasement trade, protectionism, Trump gets elected, Germany does fiscal stimulus. It's all tied together.
The narrative that seems to surround this is always the term U.S. exceptionalism. Is it dead? And I read a lot of articles about it. I read a lot of research with analysts coming out and saying that maybe it's not dead, but it's been pushed to the back of the bus, so to speak. Where do you come out on that?
Well, my view to investors, and listen, we run benchmark-oriented, models for multi-asset ETF portfolios, right? I mentioned that we have, some of our quant stock selection models for advisors that just want like stocks and they don't really care about international, or we have our ETF business. But when we take on, an advisor that wants 60-40, 70-30 type exposure, we say to them, look, we're going to be benchmark-oriented. If you want to tilt away, we have other solutions for you. But, right now we feel very, very compelled to own non-US because, US is fairly expensive, as we all know. And, there's a lot of non-linear asymmetric risks out there in general, and particularly in the US, right? Like you mentioned, AI, is it a bubble? I think like the thing for us is like, okay, international stocks, we know that they're cheaper, 30 to 50% cheaper than the US. There's equity risk premiums, right, ranging from like 250 bips as much as like 500-600 basis points. If you're a DM, it's like 200-300. If you're EM, it's 500-600. In the US, large cap equities have like 30 basis points of equity risk premium. So the idea is that non-US is cheaper. It offers diversification. Anytime the markets tank like it did during COVID, S&P was down like 34%. Non-US was down like half that. This year, when tariffs came out, U.S. was down quick 25%. Non-U.S. is down less than that. So it offers diversification.
I get the valuation argument. Well, I guess my pushback is when it comes to U.S. exceptionalism, is I wonder how much of it is just valuation oriented and trying to collapse that spread that's been out there. Maybe that spread has gotten too far. But a couple of things when it comes, it seems that much of the innovation in the world starts right here in this country. Most of the molecules in the world are invented here in the United States, not outside this country. And then finally, the rule of law. There's the rule of law in the United States, and I always worry about some of these international markets, especially some of the emerging markets. I'm going to wake up one day and the rules are going to change, and an industry is going to be nationalized. And I remember I started off at the bottom. I started off as a broker at Merrill Lynch in the early 90s. And I think one of the very first investments I ever made was a Latin American mutual fund in the early 90s. I invested on a Thursday, came in on Monday, and it was down 30% because they had devalued their currency, or Brazil had in there. And so at least I get that argument, but I feel like a lot of it is the valuation spread, not as much the innovation or the growth spread. What are your thoughts there?
Well, for sure, U.S. has the best, companies in the world. But we would say, that's sort of getting to the price, right? So how do you tilt the weight to try and outperform? Because you want to believe in after tax, after inflation, risk adjusted returns. I mean, international stocks have shown, in this recent cycle, let's say, in the last 10 years, where when there's a shock to the system, and there have been shocks. 2018, we had a quantitative tightening, Fed was on autopilot. 2020, a COVID shock. This year, you had the tariff shock. The non-U.S. goes down half of what the U.S. does. So from that standpoint, it adds, quite a bit of diversification. Listen, own the U.S. is my point, but start to mix in international, so tilt away. Also, non-U.S. stocks, David, they have, they're sort of like much higher dividend yield. They buy back shares. They're more real assets. They have like more industrial stocks. U.S. is like mostly tech and communications, which dominate. I think tech and communication are like 62% of the Qs. It's 45% of the S&P. Those are not diversified instruments anymore, right? So how do you diversify your portfolio? And I think non-U.S. makes a lot of sense, given the period we're in now, where like the basement trade, dollar weakens. There's positive equity risk premiums in non-U.S. markets, and U.S. is like very expensive.
All right. I'll accept that. Let's bring it back to Astoria. All right, and the firm. You started in 2017, and the most prominent word that I think describes you guys, you're rules based, which means to our listeners here, you're trying to get the emotion out of the market, get the subjectivity out of the market. How do you feel about the world of funds right now? Because it seems like, and this should be good for you guys, it seems like active management is back with a vengeance. For so many years, all that came out were different forms of index product, just baskets of securities, market cap weighted usually. You guys clearly have a different mousetrap and are doing very well. What are your thoughts on that?
Well, I would say right now that, active ETFs, are dominating. They're taking on quite a bit of assets. The portfolio is kind of filled up with SPYs and Qs and index level products. And, we're fortunate to be working with advisors that are like open-minded and open to like, okay, most of the portfolio is centered around some type of like, passive risk. And we're going to like utilize Astoria to kind of help navigate, because there's enough evidence of like these, I'm going to say 100-year storms that keep happening more regularly. So I think like our form of active management, and truth is a lot of the other active managers, they're not like your traditional stock pickers, like Ford versus GM. A lot of them is kind of rules-based, quantitative, systematic approach. Like I think Kathy Wood's active manager approach, where you do highly concentrated stocks in your portfolio. That's, a small piece of someone's portfolio. We're trying to like populate the portfolio with like a rules-based approach, and I think we have a good process.
Well, you've succeeded for sure. Look, we're kind of running out of time, and I don't want to leave this podcast without at least getting maybe your thoughts on how we close out the year and maybe what the setup is for 2026.
So we're constructive. We've been constructive. I think now with the government shutdown, that's a catalyst for for stocks to go higher. I think there is some year-end chasing, because I think institutions have largely missed out on this rally, because there's been such skepticism, the last, 3-4 months. But we're constructive, very much still in the bull market. I would sort of say, we have tax cuts, tariff cuts, the Fed's easing. There is a Trump put in the marketplace. We wrote that in our year ahead outlook for this year. That's proven to be the case. So I would just be careful and more active and tilt away. And our tilts are tilt away from Mag 7. You go equal weight, you go international, you go real assets. Those that help you diversify your portfolio, with the idea of like, which is the ultimate goal for anyone, is to get higher up on the fishing frontier.
John, great stuff. If my viewers and the fans of this podcast want to learn more about Astoria, you and your team, where do they go?
Yeah, AstoriaAdvisors.com or at Astoria Advisors on Twitter.
All right. Perfect. John Davi, thank you so much. Thanks for being with us. We're going to have you back again real soon.
Thank you, David.
Okay, that's it for this week. Don't forget, if you want to learn more about yours truly and the Money Runner, go to my Substack site, DCNelson123 at substack.com. I'm David Nelson, and this is the Money Runner.